So one of the most important distinctions between a corporation, an incorporated business, and a non-incorporated business is that most forms of corporations actually have a formal share structure where shares are created and then different people can own shares in that company. And sometimes even companies can own shares in that company. So the corporation can and usually does have a formal share structure, and there can be different types of shares as well that give different rights and privileges to certain shareholders depending on which type of share they're actually holding. So the types of shares available depend on the type of corporation, depend on the region. Some types of corporations, like cooperatives, for example, may not even have a formal share structure. So it does depend, but it is corporations that can have a formal share structure, whereas unincorporated businesses like partnerships and proprietorships do not have a formal share structure. So this is both a good thing and a bad thing. It depends. It depends on the nature of your business and your goals and things like that. But it is important to know, and it is an important distinction, because let's say, for example, you start a business as a partnership and you're sharing that partnership 50-50 with another owner. You don't have that formal share structure. So you can actually own 50% of the shares in the company, or 51 and 49 to make it, majority owner as one of the partners and the other partner is a minority owner. You can't really issue formally those shares. So that can be a disadvantage. And let's say one of the partners wants to leave, there's no shares to actually sell. So it makes it a little bit more difficult to change ownership when it's a partnership, because it's not as simple as just selling the shares. Another disadvantage in that sense is if you are, let's say, applying for some type of grant or some type of loan where you can get favorable terms because one of the owners is a certain demographic and that demographic is more eligible for certain types of grants or loans. Because you don't have a formal share structure, you can't really prove that one of the owners is the majority owner. So in that case, depends on what you're applying for, but maybe the lender just wants to see kind of a partnership agreement that states that one of the partners is 51% owner and claiming 51% of the net income. That might be sufficient. In other cases, I don't know, maybe the lenders or who's ever approving the grant will only allow that if it is a corporation with a formal share structure. So it does depend, but again, with the unincorporated business, you can't issue formal shares like you can with a corporation. And then on the other hand, with a corporation, because you have those formal shares, what you can do is, start the corporation and you just be 100% owner. If you want to take on a business partner in the future, you can sell that new partner 50%, or maybe you start with a partner and you own 50-50 and you want to maybe that partner wants to leave the business, you can just buy back those shares. Maybe you start with 3, you want to go to 2, maybe you start with 2, you want to go to 5. You have a lot of optionality with those shares, and changes in ownership are a little bit easier compared to with a partnership or a proprietorship. You can't really change owner of a proprietorship because the proprietor is the individual. Like, you may be able to sell the assets of the business and maybe the client list or some of the goodwill with the business, but you can't really detach it from yourself in the same way you can with a corporation. And then just to add to that, with that formal share structure, you can issue different types of shares, and this would be a conversation to have with a lawyer, with an accountant, especially a qualified one in your region, to talk about the different types of shares, because sometimes shares will have different rights and privileges, like voting rights or non-voting rights, or even different rules or logistics for paying out dividends and when you have to pay out a dividend and when you don't. So it can be really beneficial. As I always say with corporations, they are more work to set up and maintain, and they are more expensive to set up and maintain, but there can be some benefits. So it really just depends on your situation as to whether it makes sense to incorporate or not. But that is a really important distinction to be aware of, is that formal share structure that you usually have and can have with a corporation that you cannot with an unincorporated business. So hopefully that was helpful. If you enjoyed the video, please click like. If you want, you can check out my YouTube channel where I have over 100 videos on business startup and business management topics. If you have a question, just leave it in the comments section. And if you're interested in booking an initial free consultation with myself to either start your business or improve your business, I will leave the link for that in the description section of the video.